Hey, you! Yeah, you! Sitting there wondering where your money goes. Let me ask you something. What do you really know about interest rates? You ever wonder why your credit card bill looks like a mob shakedown? Or why that car note's squeezing you tighter than your Nona's hugs? Stick around. I'm gonna break it down nice and simple. Capiche? Alright, listen up. I ain't gonna talk your ear off without a plan. Here's what we're gonna cover in this sit-down. What are interest rates, really? Why do they go up and down like my cousin Vinny's mood swings? What happens when they're high? When they're low? Who benefits? And who gets the short end of the cannoli? How they affect the whole freaking economy? What's APR? Annual percentage rate? Where'd they even come from? A little history lesson. Paisan. Who's in charge? A little outfit called the Federal Reserve. So grab a cappuccino and let's get into it. Chapter 1. What are interest rates? Alright, listen up. Let's keep it moving. An interest rate is the price of money. You borrow dough, you pay rent on it. Simple. Think of it like rent, but instead of a one-bedroom in Brooklyn, you're renting somebody else's cash. Now, let me paint you a picture. Let's say you borrow $1,000 from the bank. The bank slaps on a 10% interest rate. That's 10%. It means you gotta pay back an extra $100 just for the privilege of borrowing the grand. So instead of returning $1,000, you're returning $1,100. You ain't just giving back what you took. You're paying rent on that money. See? Now, here's a term you gotta know. Principal. No, not the guy who ran detention back in high school. I'm talking about the original amount you borrow. That starting stack of cash. In our example, the principal is $1,000. So when they say 10% interest, they mean 10% of the principal. 10% of the $1,000 you borrowed. The higher that interest rate, the more you owe on top of the principal. More principal equals more pain. Let's say your buddy Frankie borrows $1,000 at 5% interest. He pays back $1,050, no sweat. But your cousin Tony, he borrows the same $1,000 at 25% interest? Yikes. He's paying back $1,250, a whole quarter more than he borrowed. That's the game. The higher the rate, the heavier the hit. This one's easy. They charge you interest just on the original amount you borrowed. That's it. Let's say you borrow $1,000 at 10% simple interest for 3 years. Each year, you pay $100 in interest, 10% of $1,000. No changes. Over 3 years, that's $300 in interest. Total payback, $1,300. Now, this one's a little sneakier. With compound interest, you pay interest on the principal and on the interest that's already piled up. It stacks up like my Aunt Rosa's lasagna. Let's say you got $1,000 at 10% compounded annually. Year 1, you pay $100, 10% of $1,000. Year 2, you pay $110, because now they're charging 10% on $1,100. Year 3, you pay $121, 10% on $1,210. It keeps growing, like interest got interest. By the end of 3 years, you're paying back $1,331. Not just $1,300. They call it the snowball effect. I call it forget about it. If you ain't paying attention, fixed means it don't change. It stays the same the whole time. If it's 7%, it's always 7%. No surprises, no funny business. Kind of like ordering a plain slice in Queens. You know what you're getting. You borrow $10,000 at 7% fixed for 5 years. Each year, you pay $700 in interest. Total interest, $3,500. Boom. Predictable. Like Uncle Louie's Sunday poker game. This one moves up and down, like the stock market, or your Aunt Gina's mood swings. They start low to reel you in, but if the market shifts, your rate can spike. You borrow $10,000 at a 4% variable. Year 1, $400 in interest. Year 2, rate jumps to 6%. Now it's $600. Year 3 goes to 8%. Now you're coughing up $800. It can be good, or it can burn you. It's like buying sushi from a gas station. You're taking a risk. So now you know. Interest rates are the rent you pay for borrowing money. Principal is the base amount you borrow. A higher interest rate means you pay more back. Simple interest is straight math. Compound interest is interest on top of interest, the stack attack. Fixed rates stay steady. Variable rates, they do the cha-cha. Capiche? Chapter 2. Why do interest rates go up and down? Interest rates don't move on a whim. They rise when the economy's heating up. Too much spending, prices ballooning, they call that inflation. They fall when the economy's sluggish. Nobody's buying. Job market's sleeping. It's like steering a car. More gas when we slow. Tap the brakes when we're speeding. Chapter 3. High interest rates versus low interest rates. When interest rates are high, savers, you're loving it. You're earning more. But borrowers, forget about it. Mortgages, car loans, business loans, everything's more expensive. When rates are low, borrowing is cheap. You get that dream house or open a pizzeria. But saving, you might as well hide cash in a shoebox. Oh, and who benefits? High rates? Banks, lenders, savers. Low rates, home buyers, entrepreneurs, big spenders. Chapter 4. How do interest rates impact the economy? Interest rates are like the thermostat for the economy. Crank it down, people borrow, build, and buy. Crank it up, people tighten belts. Inflation chills out. It's how the money managers steer the whole freaking ship. Chapter 5. What is APR? How does APR affect you? Alright, before we go any further, let's talk about something that's always lurking in the fine print. APR. That stands for annual percentage rate. Sounds fancy, right? But it's just the total cost of borrowing money, expressed as a yearly rate. Now here's where it gets spicy. APR don't just include the interest rate. It also throws in fees, loan origination fees, closing costs, all that jazz. It's like ordering a pizza and getting charged for the box, the sauce, and the delivery tip too. Let's break it down real quick with some examples. You got a credit card. The APR might be 20%, 25%, sometimes even 30% if your credit score is looking like a mugshot. If you don't pay off the full balance every month, that APR hits you like a baseball bat in the wallet. Cars. Oh boy. APR depends on whether it's new or used. New cars, lower APRs, maybe 3 to 5%. Used cars could be 6, 10, maybe more. Why? Because lenders think they're riskier, more likely to break down. Like your cousin Joey's last 3 relationships. Now, mortgages. That's big money. APR includes your interest and the sneaky fees, appraisals, points, underwriting. It helps you compare loans apples to apples. So remember, APR tells the real story, not just a pretty headline. You see a flashy interest rate, always ask, yeah, but what's the APR? Capiche? Chapter 6. Why do interest rates exist? This ain't new. Interest been around since ancient Rome. Yeah, Caesar charged interest. Lend money, you got something back. That's the deal. Over time, it became the foundation of modern finance. Chapter 7. Who sets the rates? Here's where it gets spicy. The Federal Reserve. These guys, aka the Fed, pull the strings on interest rates. The boss is called the Federal Reserve Chair. Right now, that's Jerome Powell. What happens when the Fed raises rates? Loans get expensive. People stop spending. Economy cools. Lowers rates? Loans get cheap. People spend, borrow, and build. Does nothing? Markets panic. Politicians start hollering. Voters ain't happy. Who feels it? Consumers. Your mortgage, your credit card, your student loan. Businesses, cost to borrow for expansion. Politicians, angry voters. Markets, volatile, nervous, sometimes irrational, like Uncle Lenny at Thanksgiving. Hey, let's bring the cell home, nice and clean, like my Nono's tablecloth, before Sunday dinner. Here's a rundown of all the big hitters we talked about. No fluff, just facts. Interest rate, the rent on money. You borrow dough, you pay rent on it. The more you borrow, the more you gotta pay back. Simple as that. Principal, the starting stack you borrow. That's the original amount you borrow. The big stack before the interest even kicks in. You borrow $1,000. That's your principal. That's what all the math starts from. Simple interest, flat rate, same payment every year. You only pay interest on the principal. Nothing extra. Same amount every year. No surprises. Like a straight-up guy making good on a handshake. Compound interest. Interest on interest. A snowball. This one's got layers. Like a good lasagna. You pay interest on the interest from the year before. It grows fast. Like weeds in your Aunt Marie's front yard. That's the snowball effect. And it rolls quick if you ain't watching. Fixed rate. It don't budge. Doesn't change. Stays the same the whole time you're paying off the loan. Predictable. Like Sal's Pizza always being open on Thursdays. Variable rate. Up and down. You ride the roller coaster. This one's a wild card. Goes up or down depending on the market. Starting low might sound sweet until it spikes and leaves you crying into your ravioli. Why rates change. The Fed adjusts the dial. Gas or brakes. They rise when the economy is too hot, like trying to cool down Uncle Vito after his espresso. They drop when the economy's cold, like my cousin Paulie's career as a magician. High versus low. High equals save more. Low equals borrow cheap. High rates, good for savers, bad for borrowers. Low rates, good for borrowers, bad for savers. It's a tug of war. And somebody's always slipping. Who wins? Depends which side you're on, lender or spender. High rates make these guys' day. Banks, lenders, people sitting on savings. Low rates are good time for home buyers, small biz hustlers, folks looking to spend. Interest rates are like the thermostat of the economy. Turn it up, people spend less. Turn it down, people start buying homes, cars, pizza ovens, whatever. APR, the full story on what it'll cost you. APR tells you the real cost of borrowing, not just the interest, but all the sneaky fees bundled in, closing costs, loan fees, the whole 9 yards. Always check the APR, not just the shiny rate they flash in front of you. It ain't a new scam. This goes back to ancient Rome. Lend money, you get a little something back for the trouble. Been that way since Caesar was slicing up the empire. The Fed, the puppet masters of the economy. That's the Federal Reserve, the big boss of money. They raise or lower rates to keep the economy steady, like a puppet master with Wall Street on a string. And right now, the head honcho is Jerome Powell. Raise rates, borrowing gets pricey, spending slows. Lower rates, borrowing is easy. Everybody's buying. Do nothing, markets go bananas. Politicians sweat bullets. When they act, everything from groceries to gas feels it. You, mortgage, credit cards, student loans, all affected. Businesses, loans to grow get more or less expensive. Politicians, voters get cranky if prices spike or jobs tank. Once you know the terms, you can talk the talk and walk away with the cannoli. Capiche? You made it through. You're officially smarter than you were 20 minutes ago. So what are you waiting for? Hit that like button. Drop a comment about how APR hit you this year. Share this video and subscribe to Capiche 001, where complex topics make perfect sense. More plain talking, brain boosting videos coming your way. Capiche?